Dear students, well, we've dabbled in fundamental analysis, and in our next chapter, we'll take a look at technical analysis and do more than dabble, we'll skewer it. And there's one last theory, one last type of analysis, and that is often referred to as market efficiency or rational markets or efficient market theory. Now, I don't really like that name because it's, as we'll see, evident that markets are anything but rational. I would like to title this chapter, Who Can Beat the Market? Can you beat the market? Is it even possible? Should you even try? Well, those are the questions we're going to take a look at in this chapter. So let's start with a couple of quotes from Sir Isaac Newton. Yes, you know, the guy who supposedly saw the apple fall and went, hey, it's gravity. I can calculate the movements of the stars, but not the madness of men. And Sir Isaac Newton learned the hard way because he was one of the people who got caught up in the financial mania of his time, the South Seas project. Technology changes, humans not so much. So Sir Isaac Newton learned the hard way that you shouldn't follow the crowd when everyone says, boy, we're going to get rich, 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 follow me, me some too. Oops. Benjamin Graham, the author of The Intelligent Investor and the book you were going to read eventually, he was also Warren Buffett's teacher, said the investor's chief problem, and even his or her worst enemy, is likely to be himself or herself. Yeah, we're often our own worst enemy, especially when we hear that jerk down the street, he's an idiot. He can barely find his car when he gets up in the morning. And he just made a ton of money in cryptocurrencies or NFTs or whatever, or flipping condos 15 years ago, or CMGI or drcoop.com or the Globe. Yeah, the technology changes, humans not so much. So let's get started by taking a look at the efficient market theory, the efficient market hypothesis. And an efficient market is a market in which securities, and we're going to talk mostly about stocks, but also bonds and mutual funds and all the types of financial investments, treasury bonds, reflect all possible information quickly and accurately. If there are large numbers of knowledgeable investors who react quickly to new information, security prices will adjust quickly and accurately. So what's an efficient market? New York Stock Exchange, NASDAQ, London, Frankfurt, Japan, Paris, and the emerging markets exchanges where you have many buyers and many sellers. So these people believe that then whatever the price is what it should be. They also take a look at what's called the random walk hypothesis. This is the theory that stock price movements are unpredictable, are random. And you know what? They're right. In the short term, they do appear random. As we saw, do you remember the Keep a Long-Term Perspective document where if you tried to guess what the market's going to do the next month, you go crazy. But in the long term, no. So far, as the global economy has expanded and millions, hundreds of millions of people have come out of poverty for the first time, no, the stock market has gone in an exponential trajectory as the growth has been exponential. Now, are we experiencing a bit of a backlash to globalization from the rise of dictatorships and the supply chain issues after the pandemic and then an invasion? And A little bit, it seems like it. But I think in the long run, if we're going to survive as a species, as a modern civilization, I believe the future's bright. Unless we blow ourselves up, die in our own waste, meteorite, tsunami, yeah, who knows? Yeah, what might happen? But I'm optimistic. And for a thorough analysis of this efficient market theory and the random walk hypothesis and its ramifications, you are referred to a phenomenally fun book to read, folks, A Random Walk Down Wall Street by Professor Burton Malkiel. And it's one of the two books that I recommend as your first book to read about stocks. Then eventually you're going to read The Intelligent Investor with commentary by Jason Zweig. So much of this is taken from The Random Walk Down Wall Street. In the late 1960s and the early 1970s, the academics started looking at the stock market. They weren't the only ones, but they were asking questions of themselves and saying, well, how well do professionals actually do in the world? And Professor Burton Malkiel was one of them. They looked at the results and compared them to what they called a monkey throwing darts at a dartboard. And it turned out that sometimes the monkey won. In other words, random stocks they chose. And so they came to believe in this market efficiency, that there was really no way to beat the market, and so don't even try. And as they were creating their hypotheses, at the same time, this is a little bit of trivia from the 1970s, the physicists were coming up with a new and exciting models of reality that's now called the Standard Model. And they had weak and strong energies and forces, and so the folks doing the market efficiency theories sort of stole from that. So we have the weak efficiency hypothesis. This says that past data on stock prices are of no use in predicting future prices. Well, stock prices do tend to demonstrate momentum. Stock prices tend to rise more often than they fall. That makes sense. As the economy improves and the like, we should see stock prices go up. They tend to move far higher than is usually justified in what's called a mania or a bubble, or far lower than is usually warranted in a crash or a panic. And we'll discuss these momentarily. Yes, people who are fairly savvy can look at the market and say, well, this doesn't make any sense whatsoever. And there were a group of very sophisticated, we use that word, sophisticated traders, speculators, in the late 1950s, who were complaining to Sir John Maynard Keynes, the famed economist who helped the world get out of the Great Depression. These prices are outrageous. These people are paying unbelievable amounts of money for these stocks. They have to go down. And so what they were doing is they were shorting the stock. And we'll discuss shorting in detail at the end of the semester. Don't do it. It's dangerous. But the idea is you want the stock price to go down. And you can lose a lot of money very quickly, folks. Don't do it. And we'll explain why later on. And these people were losing their shirts, right? These are people with a lot of money, and they're losing a lot of money. They complained to Sir John Maynard Keynes that the market was irrational, that it was way overpriced. And his famous response was, the market can stay irrational longer than you can stay solvent. And it is so true. You can be absolutely sure that prices are way too high or way too low, whatever, but in this case, way too high. And you probably will be right in the long eventually, but in the short term, you're losing a lot of money. And I have a buddy who's much more aggressive than I am as an investor. And in the mid-2000s, he and I were both convinced that housing prices had gone way out of whack And a lot of these companies that were supporting the housing, specifically the home builders and the mortgage companies, were going to get hammered. They were just going to get destroyed. And he started shorting the stocks. And I begged him not to do it. I begged him not to do it. I said, you can lose a lot of money. He was absolutely right. He was just too soon. So he lost a lot of money and he couldn't stay solvent. So the market stayed irrational longer than he could stay solvent. Now, this weak efficiency hypothesis says that past data on stock prices are of no use to predicting future prices. And if this theory is true, then technical analysis that we cover in the next chapter is actually useless. And in general, in the short term, I tend to agree with the weak efficiency hypothesis that in the short term, months, maybe a year or so, there's no use in predicting future prices. And that's why I'm not a very big, in fact, I'm an anti-fan of technical analysis. The next category is the semi-strong efficiency hypothesis. That states that abnormally large profits cannot be consistently earned using publicly available information. In other words, no amount of analysis that you or I do to determine the future price of a stock will help us beat the market. Well, there's a problem with this theory. There are many investors who have beaten the market over statistically significant periods of time. So you got a problem here. You got a theory that says nobody can do it, and here are people doing it. It reminds me of the aerodynamic engineers. Very quickly, humans figured out flight in the early part of the 20th century. And then they would look at animals that were flying and say, okay, that's how this animal flies, that's how this animal flies. And then they got to the bumblebee, the big bee, not the small honeybees, but the big bumblebee. And they said, wait a minute, they shouldn't be able to fly. Isn't it good that nobody told the bumblebees that they couldn't fly? It wasn't until the 1990s that they finally figured out what the big bumblebees were doing to get them to fly. So here are people saying that there are people who can't beat the markets, but they are beating the markets. So what does the theory say about these investors? Well, they say they're just lucky. Okay. It reminds one of the famous quote that's attributed to many different golfers. Type it and go look at it and you'll see it's many different golfers. The golfer did really, really well and beat everybody else. And the reporter said to him afterwards, you were really lucky out there. And he said, you're absolutely right. I was. But the funny thing is, the more I practice, the luckier I get. In other words, sure, the average person can't hit a little white ball 400 yards in 3 shots down into a tiny little hole. But there are people who can, and those people who can are very wealthy because of it. There are people who can hit a fastball at 98 miles an hour. Can you do that? I'm not even going to try. And if you can do it 3 times out of 10, you're going to make a lot of money. So as we'll see, the average person, the average analyst, the average money manager maybe doesn't beat the market, but there are people who have done it over statistically significant periods of time. If this theory is true, and I don't believe it is personally, both technical analysis and the fundamental analysis, which we covered in the previous 2 chapters, are useless. In other words, folks, what we did in chapters 4 and 5, forget it. There's no way we can hope to beat the market because the theory says we can't do it. And you know what? I'm not that interested in beating the market. I want to buy good companies for the long term, get dividends. I don't really care that much. I don't have to win big. I just want to win. Slide number 5 is the strong efficiency hypothesis. No information, public or private, allows investors to earn abnormally large profits consistently. This is absurd. one insider information trade can make you rich overnight. If you don't get caught, that is. If you know that a certain drug is going to be denied by the FDA and you sell your shares before the rest of the world knows, that's what we call insider trading. The Securities and Exchange Commission calls it material non-public information. If you trade on material non-public information, you are committing a crime and you can go to jail. And the famed example of this was, what's her name? Martha Stewart. I did my best not to know what she even looked like, folks. I'm not much for the consumable culture of celebrities and the like. But then when she got in trouble and what happened? What happened? She used to go out with a guy who was the CEO of a drug company. And he and she shared the same stockbroker. Okay, well, I guess they were still friends, but they're no longer dating. They're no longer an item. Well, this guy, the president, knows that the drug is going to be denied. So he starts telling his stockbroker to sell the shares. The stockbroker calls up Martha Stewart and says, Sam, that's his name, Sam, I forget the last name, is selling. So she starts selling her shares before the material non-public information is public, which is a crime. And they catch both of them. And I think, my understanding, I might get this story wrong, but she could have just fessed up and they would have, I don't know, given her probation and a fine or something like that. But instead, she kept her story and said, no, I didn't do it. But basically, she lied. So she got in trouble for perjury, which is even worse than insider trading. And I think, I don't know, you have to ask her publicists. They said, this is great. You go to jail for 4 months. This is fabulous. 5 months. You can't get this kind of exposure, of celebrity status. They'll have videos of you teaching the other inmates how to make a turkey or whatever. I don't know. You folks who love celebrities, find out what happened. But this version of the hypothesis, this version of the theory is absolutely false. It is absolutely ridiculous. One trade, if you knew that was going to happen, you could make a fortune overnight, but you can also go to jail. Okay. The efficient market and random walk theorists are often also major proponents of index funds. They point to the fact that many professional money managers simply do not beat the market, especially during bull markets. Between 1963 and 1998, the Standard & Poor's Index outperformed general equity mutual funds 22 out of 36 times. So they reason you're better off accepting close to the market's return with low-cost index funds, since their theory tells them that no one can consistently beat the market, even though there's people who have beaten the market. Now, why do we say close to the market's return? Because remember, even index funds have some annual operating expenses, so they're not going to match the market, except for those 3 fidelity funds that don't charge you any annual operating expenses. They're going to basically match the market. Are you with me? Understand what's going on here? These people believe that there's no way that you're going to do a good job, so don't even bother. Pack up, go home, buy an index fund. Why can't many pros beat the averages? Well, there are various reasons. Many mutual funds have high annual operating expenses and high turnover rates. And many mutual fund managements have a very short time horizon. Consequently, and this is changing, thankfully, many mutual fund managers have a very short lifespan. Okay, so here's the scenario. It's getting better because there are companies that haven't done this over decades, and the other companies are saying, hey, they've done better than we have. Let's follow them. But the big one was Fidelity. The granddaddy, I forget his name, Mr. Johnson. I call him Mr. Johnson. And his granddaughter or his great-granddaughter is in charge of the company now. He was very frank about this, very open. He said, look, we throw somebody into the mix And if they do well, great. We shower them with love and attention and money. And if they don't, oh well, they're they're out the door. Now, these people are not stupid. They come from the best schools, best business schools in the nation. They have high pedigrees, and they know that if they don't excel, they're going to be out the door in 18 months, 2 years. So they subsequently would take greater risks than what would a prudent, long-term oriented investor would be interested in. And if they do great, great for them. They get showered with love and attention and money, and you do well as an investor. If they don't do well, oh well, they knew they were going to get kicked out anyway. So now you see companies giving their managers much more time, grooming them before they throw $1 billion at them. Here, kid, here's $1 billion. See how you do. And that's a good sign. That's a good sign. So I look for companies that have done that for decades. So it is difficult. You have to beat the market by your annual operating expenses right off the bat just to stay even. But the premises and casual observations of the efficient market theories show them to be patently absurd. There are many mutual fund managers and other managers who have beaten the market over statistically significant long periods of time. The more I practice, the better I get. Plus, if markets are efficient and rational, how do you explain manias? Are people rational? No. No, 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 no. And there was a branch of economics that said, oh yes, people act rationally. And that branch of economics had a stake driven through its heart, not by an economist. There were two psychologists, and Kahneman, Daniel Kahneman and Amos, I forget his last name. Daniel Kahneman won the Nobel Peace Prize for economics for his work in psychology, and poor Amos passed away before you can't win the Nobel Peace Prize posthumously, so he didn't get to win it. But the book is called Thinking Fast and Slow, and it's a wonderful book, folks. Read it, read it, read it. It'll turn some of your assumptions about yourself on its head, because they really did show that people aren't rational. They don't make decisions rationally. But we knew that, didn't we? I mean, we fool ourselves, don't we? We fool ourselves and think, well, I'm rational. Oh, those people aren't. Occasionally, investors get caught up in what are called manias, also called bubbles. A mania, bubble. What else? Another name. Me some too. Look at that person. He made a bunch of money. He's a goofball. I can do it. The internet bubble of the late 1990s was the latest stock mania. Are we in a mania now with stocks? Well, with some companies, I would say yes, but not all companies. Not all companies are not like it was at the late 1990s. But then even the late 1990s, a lot of the old economy companies were just not, fuddy-duddies. Why would you buy a railroad or a food company? And some of it not as bad as it was, though, folks. It was bad. It was pretty. Some of you weren't even alive yet, but you saw a company that would go public $12 and first sale was at $90. This happened over and over and over again. Yeah. Before that, there was the Nifty 50 of the early 1970s, when stocks that had something to do with technology, like Tektronix and CalComp, which are, by the way, gone. Avon was one of the Nifty 50, and Xerox and Polaroid. Polaroid? I wouldn't want to own a company whose name rhymes with hemorrhoid. I don't know about you. The name lives on. The company's long gone. Before that, the 1920s, there was a mania in the late 1920s, and it was companies like Radio Corporation of America. You've heard of Radio Corporation of America, haven't you? Well, you've heard of them as RCA. RCA. It lost over 90% of its value, went from 210 down to $2? I don't remember. Yeah. The mania of the 1840s had to do with railroads, the new technology, 400 railroad firms. How many are there now? Less than a handful. But the granddaddy of all manias was probably, well, I don't even know, because there's some controversy about this. But the granddaddy of all manias was the tulip bulb craze in the Netherlands in the 1630s, 1640s. One tulip bulb at the height of the bubble sold for what a house would sell for at the time. People started trading tulip bulbs as if they were stocks. And the price just kept going up and up and up until the bubble burst. And then, because what happens when you put a tulip bulb in the ground? It makes more tulips and you wind up with more tulip bulbs. One poor slob who just arrived in town, a sailor who had no knowledge of what was going on, found one and thought it was an onion because they're related, tulip bulbs, and ate it. What did he get in a lot of trouble? And there's two wonderful books. I want you to read, folks. Libraries are cool. And you don't even have to go to the library anymore. You can just download them on your phone and read them. Extraordinary Popular Delusions in the Madness of Crowds. This book was written in the 1840s. And it still is shocking. It still makes you wonder how rational humans are. And you realize that we're not. They talk about the witch hunts, the witchcraft, and the Crusades, and the South Seas, Louisiana, South Seas, and the Louisiana peccadillos, financial peccadillos, where people lost their life savings. Another good book is The Botany of Desire, that talks about plants, and he discusses the Dutch tulip bulb craze, but he also talks about our relationship with plants. And we think we're in charge of the plants. Hey, we're in charge of the plants. No, the plants they're in charge of us. They get us to plant them and feed them and keep away their enemies and keep away the bugs. And they're thinking, hey, these humans are okay. So they're both wonderful books. Fun reading. It's a lot better than television, folks, because the pictures in your mind are a lot better than the pictures on the screen. I don't care how much they throw at CGI. Every time the phrase was, it's a new era, it's different this time, the old way of valuing stocks are gone, and guess what? Each time they were wrong. So much for rational, efficient markets. And so, why do manias occur over and over again? Why haven't investors learned their lesson? Any ideas? Well, here's Leonard Kaplan, president of commodities brokerage firm Prospector Asset Management in Evanston, Illinois, and I love his quote. Market manias will happen over and over again because the public is infinitely stupid. Here's what Benjamin Graham had to say. The speculative public is incorrigible. It will buy anything at any price if there seems to be some kind of action in progress. It will fall for any company identified with franchising, computers, electronics, science, technology, or what have you, when the particular fashion is raging. The abuses are so largely the result of the public's own heedlessness and greed. Now, he wrote this in 1972, his last edition. He made 4 editions of The Intelligent Investor. This was the last one. He passed away, sadly, in 1975. So the technology was different, right? You replace franchising, computers, etc., with internet biotechnology. And good old Ben could have been writing in 2000 instead of 1972. Today, the buzzwords are cryptocurrencies, meme stocks, NFTs. Are we in a mania bubble now? Well, I certainly believe that cryptocurrencies, I call them kleptocurrencies, are a continual bubble. They're so easy to create, right? It's just so easy to create. In 2000, there was only so many new technology companies that you could take public, because eventually they wouldn't take them anymore. And so now, even if a cryptocurrency falls, 99%, all you got to do is start another one, because it's just an algorithm, and then get some celebrity to say how wonderful it is as he gets paid tremendous amounts of money. And the same thing is true for NFTs. You could just make another graphic, and wonder of wonders, people will pay you $69 million. So I do believe that eventually the bubble will burst and then be reflated and burst again and reflated. The public is infinitely stupid. One of my students said it really well. I really like this. This is several years ago. He said, look, it's easier to fool 1 million people than it is to fool one. And I really believe that. It's easier to fool 1 million people than it is to fool one person. So manias will be with us forever. The technology changes, humans not so much. So next slide here. How do most manias end? Of course, I mean we can't just leave it at the mania stage, right? How do most manias end? Yeah, you guessed it. They invariably end with a crash, also known as a panic. The bigger the party, the bigger the hangover is a great saying I like to think of. They are not fun, folks, but the odds are you will live through at least one, probably two, maybe more as the technology keeps ramping up faster and faster and faster during your investing career. Now, here's a gentleman who had 49 years, almost 50 years experience when he said this in August of 1999. With this many strong years, I have the concern that there are a vast majority of companies that are significantly overvalued on a long-term basis. Now, this was August 1999. Every few days, another internet company was going public and the price was skyrocketing. And a lot of the companies in the technology world, we're going to revisit that one slide. I'll show it to you in our next time we get together. Were just outrageous. And so here's this guy at the end of his career, about ready to retire. John Lovelace, he's the gentleman, the son of the gentleman who started the American Funds Capital Group, but he's often responsible for creating what it is today. He really took the reins and made it the huge mutual fund company is today. Now he's saying, stocks are overpriced. And luckily for him, he retired the next year in 2000, just as the bubble started to burst. So he got out while the getting was good. And by the way, as we said, the 2008-2009 market crash was not caused by a stock market bubble, although some stocks were very expensive. It was a real estate bubble and the mortgage-backed bonds that were tied to the real estate mortgages. We'll see those when we get to bonds. So here are the 13 worst days of the Dow Jones Industrial Average. Now, we included the 2 days here in 2020, but we should just throw them away. Why? Because that had nothing to do with the stock market and everything to do with the pandemic, when people thought the world was going to end and they just sold off everything they could think of. Look at that, 13%, 12% downturn. Oh my goodness. But that was because, 10%. There's 10% downturn. That was because people really did believe that, vast majority of the human population was going to die. And then we realized, no, a lot of people are going to die, but civilization is not going to end. It's just going to be a real pain in the patootie for a lot of people, the end of the world for a lot of people. So we throw those away. There's the worst day, October 19th, 1987, 22.61%, the Black Monday, as it's called. But so we now look at it as 11. And it turns out that 6 out of the 11 are in later October. One of them is in early November. So 7 out of 11 of the worst days were at the same time of the year. Now, why is this? There are several reasons given, but none of them are very good, in my humble opinion. So, what are we left with? My take on it, and there's no way to prove this, is that we are all still animals. We're humans. Homo sapien homo. And so, as much as we'd like to think that we are divorced from the material, from the natural world. You go inside, flip a switch, press a button, new climate control, electronics. We still are ruled by our emotions. And at the end of the year, at the fall, there's a reason why we call it the fall, we see the light getting dimmer. We see the trees and the plants start to die. Animals go to hibernate. It gets colder. And we instinctively know that 1,000 years ago, 10,000 years ago, 100,000 years ago, our ancestors looked around at one another and said, well, you know what? Not all of us are going to make it through the winter. And so, as a society, we panic. There's a reason why All Hallows Eve, Halloween, All Souls Day, All Saints Day, the Day of the Dead. There's a reason why they're in the fall. Now, of course, nobody knows. There's no way to prove this. And some people might say, well, how come it's not the dead of winter? How come it isn't the Christmas time and the New Year's, the winter solstice? And you got to look at the symbolism, right? Christ was supposedly, we don't really know when his birthday was, but they attribute it to near the winter solstice because he was the light of the world. And that's when the pagans would all get together and call upon the sun to start its journey back to the realm of the living. And so that was the birth of light. See, that's the hope part. The witches and the goblins, that's the scary part, the time of death. Interesting. And if this piques your interest, there's a wonderful book called The Hero with a Thousand Faces. So check it out. Hero with a Thousand Faces talks about all the different religions and the symbolism and how they all interweaved. And if that doesn't pique your interest, it was the book that George Lucas used to create Star Wars. And it's a book that Disney has stolen from lots of times. Other people have stolen from. The Lion King is basically The Hero with a Thousand Faces. They will never admit to that, but it is. So check that out. And then lastly, let's take a look at a history of bear markets, because it's going to happen, folks. I wish I could tell you it wasn't, but it's going to happen. There's going to be times. In fact, I've been thinking of waiting until doing this presentation, because here we are in what is it? It's March, and the Dow is, the S&P 500 is pretty close to another bear market. The Nasdaq's already in a bear market. So where are we? We are, pretty close to a bear market. I don't know exactly. It was pretty close. It was like 17% down or so. 20% is a official bear market. But here, and of course, if you're looking at this on a smaller screen, it's going to be hard to read. But you see that bear markets, except for the granddaddy of them all, the Great Depression, where the stock market lost 88%, they are, 20, 30, here's the tough one, 1973, 1974, 48%, 2000 to 2002, 49%, 2008, 57%, and then the COVID-related one was the quickest bear market and also the quickest recovery. Amazing how fast it went down in the pandemia. But you'll notice that the months to recover are usually not too bad, except for the granddaddy of them all, the Great Depression. But, it takes a year or so, maybe a few years in the case of 73, 74, and 2008 and 9. Those that took a while, 4 or 5 years. But it'll come back. It'll come back. And if it doesn't matter where your money is. Notice the PEs, as they get really high, they come down. The real dramatic one was 2007-9, the 2008-9 drop, where the PE went from 23.6, not as bad as the PE in the internet bubble, 37.4, down to 9.7. What a buying opportunity, right? 9.7. So dealing with the bear markets is something that we emotionally have to be ready for, and realize that if the world does end, it doesn't matter. But I'm very optimistic, assuming we can get our political act together. And I'm very confident that if we can work together as a world, we're going to beat the climate change. We're going to fix it. We're going to do it. We'll see. We'll see. I probably won't be around, right? But you younger folks, you're going to have to deal with it. So good for you. You're going to do it. You got the tools to do it. Okay, I've burbled on enough. My apologies. Now, in our next presentation for Chapter 6, we're going to take a look at what is often called investor psychology and some common weaknesses that we investors have just because we're human, because we're irrational. We'll also take a look at some all-stars of investing and some famous myths and stupid sayings. And then we'll revisit the controversy over passive versus active management. Okay? All right, dear students, be awesome. We're proud of you. We're amazed at how well you have done, how much you have learned. You should be very, very proud of yourself.